Hi everyone, and welcome to our discussion today on this topic, which is about measurement of assets and liabilities under IFRS 16. Friends, we've already talked about that virtually every kind of a lease arrangement would require the leased asset to be recognized in the balance sheet and the corresponding lease liability also to be shown in the balance sheet of the lessee, right? We have talked about the exceptions to that rule, where we talked about for example, a short-term lease or a lease of low value assets. Very specific exceptions given to the recognition of assets on the balance sheet of the lessee. So keeping those off, we are now discussing in terms of how should we recognize the asset and let's say even do the initial measurement of those assets in our books when we have entered into a lease arrangement, right? So in that regard only I'm going to talk about today is how to, for example, evaluate or the value the particular asset and the corresponding liability under IFRS 16 here, right? Let us say that there is a company X, that is a lessee, enters into an arrangement with company Y, calling it a lessor, to use a building for 10 years, right? Let us say further, the agreement allows company X to use the building for an additional period of 5 years. The terms will be negotiated later between the parties if company X, that is a lessee, wishes to extend the lease, right? It is not clear at the inception of the contract whether the lease term will be extended beyond the original agreed period of 10 years, right? So we are given this information already that the original lease term is 10 years. There is an option to extend, but the terms would be discussed later if there is a need to, or there is a requirement to extend the lease by another 5 years, which and it is also further given that there is no clarity, there is no reason to believe that this lease will extend beyond the original tenure of 10 years of time, right? So let us say further that company X agrees to pay $500,000 per year for the first 10 years in advance, right? It also incurs a direct cost of $80,000 to enter into the lease. Okay, so what we, let's say, given this scenario, I'm just looking at one part of the scenario, and I'm going to even talk about, let's say, if there's an extension taking place at a later situation, right? So what we are given the information about is there is a lessee, there is a lessor, and there is an asset under consideration, right? There's an arrangement where the lessee carries a right of use to the asset, a right of use asset, and of course, the tenure is defined as 10 years. There is an extension period also of 5 years, but then we are safe to presume that this 5-year may not happen, and it cannot be determined at the time of entering into the contract if this is likely to happen at all, right? So now, given this situation, we are also given some amounts, say $500,000 per year for the first 10 years, and that too is given as an advance payment, and there are some direct costs, right? Now if I look at it, we have talked about this before in the previous lectures, where we say that first of all determine the liability amount. Okay, so you need to determine, of course, the liability amount. And how do we do that? We simply say, look at the present value of cash flows, right? So we know that there are 10 payments of $500,000 over 10 years time, and you are making a payment in advance. So discount that. Let us say that the current interest rate, I'm using a term incremental borrowing rate. I'm not getting into the details of this at this point in time, but let us say if this incremental rate is 6% for company X, right? So these cash flows need to be discounted at this particular rate. Okay, so when I say that I'm looking at this particular rate, I would be absolutely comfortable. Of course, we use even an Excel as a basic thing. Of course, in front of us we don't have that a facility to use some tools, or we don't even want to calculate this, because I'm not carrying a calculator honestly at this point in time. But if I say I need to calculate the liability, assuming that the lease is only going to last up to 10 years of time, because it cannot be ascertained if the lease is going to get extended beyond 10 years, then we are simply saying I would prepare a chart something like this. At the beginning itself, I'm paying $500,000. Since it's the start of the contract, I'm marking it as year 0, right? And then at the end of year 1, I'm making another payment. 2, 3, 4, 5, 6, 7, 8, and 9, of course, because what we are saying here is that the payments are made in advance, which means that if I look at these amounts, of course, they would be the same each year. just taking a bit of a time to kind of just showcase it on the board. But then since we have an incremental borrowing rate given at 6%, we are saying that the present value of, let's say, since I'm paying it upfront, something paid today has a present value of the same amount, right? So this becomes the present value of the first installment. The second installment's present value, of course, can be calculated like this: the amount paid after 1 year, the discount rate, of course, to the power 1. Likewise, we can do these calculations for the entire series of payments, something like this, right? So this should be, of course, comfortable for you to measure it there and then, right? Of course, we use different tools. Excel sheet, of course, is one of the easiest way to calculate these amounts here. So whatever this amount comes to, we don't want to worry too much about that, but that becomes your the first value of your liability as well as your asset. But then we know that as well, the direct costs to get into the lease, the cost without which the lease could not have been entered into. So what you're saying is this 80,000 is further added to the cost of the asset and not to the liability, right? So when I say that, I'm looking at the present value of lease liability. I'm not sure of the calculations here, but let us say it comes to, since we're talking about $500,000 for 9 years discounted plus 500,000 upfront, let us say this comes to let's say 3.5 million, right? I'm not too sure how much this amount is going to be, but if I say that the present value of this entire series of payments is 3.5 million, I know that on day 1 I paid $500,000 to the lessor, right? And of course there are direct costs associated with the lease of $80,000. So all we are trying to do now here is, all we are trying to say here is that my asset is recognized at something like this. I would do an accounting entry of finance lease asset or right of use asset. That's a more appropriate term. I'm looking at the present value of all the amount that I'm supposed to pay plus the direct cost. So my amount will be 3.5 million plus 80,000. So this is something which is the value of your asset or right of use asset, right? Against this you have lease liability. And how much is that? The present value is 3.5 million, but you have already paid 500,000. That means that the value remaining becomes 3 million, and of course I have paid 500,000 plus 80,000, so this becomes 580,000, right? So this is how you would do the initial measurement of the right of use asset and the lease liability, right? So the way we are going to kind of showcase it in our books, that there is a lease liability of course we have just assumed a figure of the present value here. So we are saying that the lease liability remaining is 3 million. There is a cash payment of 580,000. The leased asset is becoming at a value of $4.3 million here, right? This right of use asset, the right of use asset is depreciated over the lease term, which originally is of course 10 years, and the lease liability increases by the interest or finance cost and reduced by the amount paid over the balance lease term. Are we comfortable in this so far, right? So this is something that you want to kind of take into consideration when you want to, let's say, do the initial measurement of both the right of use asset and the lease liability, right? Of course, the discussion does not stop here. You may want to kind of consider that how should this right of use asset be subsequently measured, right? How do we subsequently measure this right of use asset? We have again an option of using the cost model or the revaluation model, and accordingly, the applicable accounting standards, be it property, plant and equipment, or be it an investment property accounting standard, the provisions of those accounting standards would now apply at the time of subsequent measurement, right? But then we did not want to worry about that piece. We rather wanted to discuss if there is a modification in the lease term, then what happens? If something changes, about the lease, then how do we deal with that part? How do we account for that particular difference? Let us say that after 4 years, company X decided to extend the lease for further 5 years, of course, as per the option available to the company, right? Now, we are given that at this point in time, the rentals applicable for the extended period are, let us say, $600,000 per annum, right? And the borrowing rate has gone to, let us say, 8%, right? The two things that we are looking at is that you are extending the lease by 5 years. The rentals would be $600,000 and the borrowing rate is going to be 8%, right? So one thing is for sure, that now I'm going to talk about something like this. Another 5 years extension, my new interest rate would be, or the amount would be, of course, $600,000 per annum. And since you said that after 4 years of time, so I'm done with this point, this point, this point, this point, and this point. I've made 5 installments payment already, and I'm now left with year 5 until year 14 end, right? So we need to be absolutely sure about what we're going to do here. We have made 5 installments, and towards the period 4, we are saying that we want to, let's say, extend the lease for another 5 years. The incremental period, the additional period for which we're going to take the lease, the rentals are 600,000 each year, and the borrowing rate has changed, let's say from 6% originally to 8% here. So what do we do? How do we measure the right of use asset and, let's say, even the liability, right? One thing that we need to consider here for sure is that both the right of use asset, the value of that has increased since the lessee, company X, is given an option to use the asset for a further period. Not just that, since the company is given an option, or it is able to, let's say, use that option to use that particular asset for a further period, there is a further cash outflow which automatically increases the value of the lease liability, right? So that is something that we need to kind of remember here, is that again, the way we are going to measure the value of the asset, the value of the, let's say, right of use asset will depend on the increased value of the lease liability, right? Let's try to make it a little easier here. We said that the original value of the asset was $4.3 million, right? Now, if I say that my annual depreciation, of course, considering that my original term was 10 years, my annual depreciation becomes $430,000, and my depreciation up to the end of year 4 would be, of course, 430,000 into 4, which means that I'm looking at, so 43 into 4, that would be 172, and when I look at 430 minus 172, I'm arriving at a value of my carrying amount. Of course, I'm using the cost model here. It becomes $2.58 million, right? Are we good so far on this? So what we are saying is, we have our assets carrying amount at 2.58 million. Likewise, I will also have the carrying value of the lease liability, right? I have, of course, carrying value of the lease liability. We said that originally the value of the lease liability was $3 million, right? The discounted value of the cash flows after having paid the advance amount remains at 3 million. This would increase by the interest, amount becoming due, and will get reduced by the installments paid, right? So let us assume, I'm again not using a calculator here, let us say that the value of these lease liability stands at the end of year 4, let's say it stands at maybe $1.9 million. Of course, this is again not the precise amount, but the calculations can be done, and that is something which is not discussed at this point in time, right? So if I say that this is 1.9 million is my lease liability when the terms changed, right? So all I'm going to do is all the future payments, will now be, of course, discounted at the new incremental borrowing rate. All future payments will now be discounted at the new incremental borrowing rate, which means what? It means that now this 500,000 and the subsequent amounts will all be discounted at the rate of 8%, right? Since we did the extension to the lease immediately after the end of 4th year, so this amount would remain as it is. Since you are paying this, let's say, okay, not this one, because this is being paid at the end of year 5. So this becomes divided by 1.08 to the power 1. The next amount will be 1.08 to the power 2. So that is how we're going to kind of do these calculations here. And this 600,000 also will be discounted at this particular incremental borrowing rate. What does that amount give to us? This amount gives to us the additional, or let's say the new value of the liability, right? We already have a value in our books, $1.9 million, for example. Of course, it is ideally it is higher than that, but then for the sake of it, I'm using it 1.9 million. Let us say the new value comes at 3, or let's say I'm changing the figure again a bit. Let us say this is 2.85 million dollars, right? So what does it mean? It simply means, of course, I need to show my liability at 2.85 million from 1.9 million. That means what? That means that there is an increase in lease liability by 2.85 minus 1.9. This becomes $950,000, and this is nothing else. It is added to the carrying value of the right of use asset. So the way we do it here is, we would simply say debit right of use asset amounting to $950,000, and of course credit lease liability by the same amount here, right? And now and onward, the asset will be shown at 2580 plus 950. This becomes 3530000, and my lease liability of course stands at 2850000. This particular asset will now be depreciated over the remaining lease term of, let's say in this case, 10 years of time, not 11 years of time, because we're going to use the asset for entire 15 years and only 4 years have gone by, right? So something that you want to kind of carry along as a learning outcome in this particular discussion here, right? Good so far. So this is something which is an important consideration on looking at how to account for any modification in the lease terms. How should the change be shown in the right of use assets value, and of course the lease liability amount as well, right? So that is something that we wanted to discuss in today's session. Keep watching these videos and do subscribe to our channel, which is AVC Learning, and all the best for your preparation. Have a good day. All the best.